All right, let's talk about hedging with spread trades. This is a trading strategy that I think really every investor should be aware of because it can be a much safer way to implement trade ideas and hold on to them through all the ups and downs. Now, a spread trade is just going to be long one asset and short another similar asset. And the goal is usually to hedge your risk by moving closer to delta neutral.
Right.
Which is just a fancy way of saying market neutral. But it's also a way to trade multiple market biases. Rather than choosing to long or short one asset, you can long your favorite asset in a particular asset class and short your least favorite asset in that same asset class.
And we say bye-bye.
Doing this technically hedges your directional risk, but you profit from whatever the difference is between the two assets, which you would hope increases from the long asset doing better or the short asset doing worse. It doesn't matter which one of those two it is, as long as the spread widens.
My man!
So say you thought Apple was mispriced relative to Microsoft and should be trading at a higher multiple. You could go long Apple and short Microsoft until those multiples converged, and you would pretty much be entirely market neutral. Whether the market goes down or up, you'll be hedged. You're just banking on Apple, in this case, slightly outperforming Microsoft. And the beauty of spread trades is there's really no limit to what kind of spread you can put on. You could go long SPY and short NASDAQ because you think tech will underperform. You could go long XLP and short XLY because you think consumer staples will hold up better than consumer discretionary. You could also go long Bitcoin and short ETH because you think ETH has more room to fall. You could even do a long gold, short oil trade. Just keep in mind, the less correlated the assets are, the less hedged you are. But if you're putting on a spread trade, you have to consider a few things, namely correlation, relative value, and volatility. The more correlated the assets, the less risky the position is because the assets will usually move about the same amount in either direction.
Nice.
And that's why the difference in relative value or volatility will likely be the gain you ultimately capture over time with a spread trade. Relative values could be in reference to something like PE multiples in the case of the Apple-Microsoft example, but they could also be something very broad like shifts in economic trends with the XLP-XLY example. And the Bitcoin ETH trade would probably be a good example of a volatility-focused spread trade because ETH tends to fall more than Bitcoin during downtrends. But keep in mind that these trades can also work in the opposite direction because ETH usually goes up more than Bitcoin in uptrends. But that's the point of hedging, because you would be long Bitcoin, so the correlation would help you mitigate some of that risk.
Yeah, baby!
So, just to summarize, hedging with spread trades is a great idea because you largely hedge your directional bias and move closer to a delta or market neutral approach. There's limitless possibilities, like I mentioned. You can go long, short, just about any asset. Just try to keep them similar if you want to really focus on managing your risk.
My man!
And the most important part is that you have less risk, but you also have less reward. Aww. Either way, it's an excellent strategy to consider. All right, that does it for this 101. But as always, stay happy, humble, and most importantly, solvent.